Critical Man Pictures presents the Forex video training series, Black Belt Second Degree, Trade Guide to the Major Economies, Switzerland. Switzerland was founded in 1291 and is located in the middle of Western Europe and shares much of its history and culture with Germany, Austria, Italy, and France. Although being right smack in the middle of Europe, Switzerland is not part of the European Union. While there were talks between the EU and Switzerland in the mid-1990s, the Swiss public rejected the proposal to be part of the EU. Since then, Switzerland has maintained its economic independence. Switzerland is considered to be a small country. Well, let's tell you, it is fucking packed. It has a population of about 7.78 million, with around 477 people per square mile. Switzerland is also known for its neutrality, as it refrained from participating in either of the two world wars. Just a little bit more data on Switzerland for your viewing pleasure. The economic overview. Switzerland is one of the richest countries in the world in terms of per capita income, that's total GDP, divided by the country's population. In 2009, it produced $488 billion in total output. As small as it is, on a per-person basis, it boasts a GDP of $43,000, which is seventh highest in the world. Its main trading partners are Germany, US, France, Italy, Australia, Russia, and the UK. Like Japan, Switzerland is also highly dependent on its exports, which make up about $247 billion, or 50% of its GDP. Switzerland's main industries are machinery, chemicals, textile, precision instruments, and watches. Don't laugh at the last one. It actually comprises a decent chunk of Switzerland's output. Anyway, time to move on. The monetary and fiscal policy. The Swiss National Bank, or SNB, which is presently chaired by Mr. Philipp Hildebrand, conducts the nation's monetary policy by influencing the country's monetary and credit conditions. The governing board, which is responsible for determining the bank's policy, consists of 3 members: the chairman, vice chairman, and the 3rd member. That's right, only 3 people are part of the board. Unlike most central banks, the SNB sets a target range for its desired interest rate, also called LIBOR, rather than a fixed figure for 3 months. On top of the purpose to control the country's money supply and influence interest rates, the SNB has a more on-hand role in keeping the Swiss franc's valuation stable. An excessively strong Swiss franc could cause inflation to spike and could also undermine the country's exports. Switzerland's strong reliance on their exports, the SNB favors a weaker Swiss franc and does not hesitate to intervene in the forex markets to weaken it. Let me reiterate that. The SNB favors a weaker Swissy and does not hesitate to intervene in the forex markets to weaken it. Good. One of the major monetary policies of the SNB is inflation targeting. The bank's inflation target, which is monitored on the CPI, is below 2% per year. The bank will then attempt to influence the country's actual inflation rate through the open market operations by adjusting the LIBOR rate. Speaking of open market operations, the bank influences the LIBOR rate through short-term repurchase repo transactions. A repo transaction involves selling a particular security for cash and agreeing to repurchase the same security at a later date. If the interest rate in the open market rises above the SNB's desired, the central bank will supply the other banks with more liquidity through repo operations at the lower repo rates. On the other hand, the S&P can reduce liquidity by increasing the repo rate, eventually increasing the LIBOR rate as well. On the fiscal side, one attractive fiscal policy that Switzerland has is that they have some of the lowest tax rates among developed nations. In fact, it is often referred to as a tax haven nation. Corporate tax rates in Switzerland run from 8.5 to 10.0%. This, in addition to its bank secrecy laws, makes Switzerland one of the most business-friendly nations in the world. Getting to know the Swissy. Not too long ago, France, Belgium, and Luxembourg also termed their currencies as francs, until they adopted the cooler euro. At present, Switzerland is the only one using the franc as its currency, the Swiss franc. Among financial geeks, the Swiss franc is known as the Swissy. Switzerland is considered to be politically neutral to its bank secrecy laws, giving the Swissy a safe haven status as well. Usually, during times of economic uncertainty, investors move funds into Switzerland, cause the Swiss franc to gain in value. Not only do the Swiss refuse to join the cool kids of the euro, but they are also the only country that still adheres to a gold standard. About 25% of the country's money is backed with gold reserves, giving the Swiss franc an 80% correlation with the price of gold. This means that whenever the price of gold rises, the Swiss franc could stand to benefit as well. Some of the economic indicators for the Swissy. The GDP, or gross domestic product, is the measure of a country's total value of all final goods and services. The report gauges the changes in the economy's total output from the previous period. The retail sales. The headline retail sales report measures the monthly change in the total value of sales at a retail level. The Consumer Price Index, or CPI, measures the change in prices of a basket of goods and services. The CPI is followed closely by the S&P, as it uses the report to help in its inflation analysis. Balance of trade. The balance of trade measures the total difference in the value between exported and imported goods in a country. Switzerland has a very robust export industry, so traders often use the country's trade balance to measure how well the economy is faring. What moves the Swissy? As mentioned earlier, the Swiss franc has an 80% correlation with the price of gold, as 25% of Switzerland cash is backed up with gold reserves. When gold prices go up, the Swissy usually goes up as well. Conversely, when gold prices slide, likewise, the Swiss franc will do so. Since Switzerland is an export-dependent country, it is vastly affected by the economic development of its major trading partners in the Eurozone and the U.S. Switzerland's major export partners in the Eurozone are Germany, France, Italy, and Austria. The U.S., meanwhile, takes about 8.5% of Switzerland's exports. Poor economic performance in any of those countries could mean less business for Switzerland. Political tension in its neighbors in Europe, particularly in the Eurozone, could cause traders to seek the safety of the Swissy. Remember, the Eurozone is a broad of 16 states, with the ECB directing and implementing a set of monetary policies for the entire group. Given that the economies of member countries grow at different paces, ECB policies sometimes go against what a single nation needs at that specific time. The dollar Swissy is also affected by the cross-exchange rates like the euro Swissy. A jump in the euro's valuation during a hike in the ECB interest rate, for example, could spill the Swissy's weakness onto other currency pairs like the dollar Swissy. Switzerland's main industry is banking and finance. Merger and acquisition, M&A activities, or simply the buying and selling of firms are very common. How can this affect the spot prices of the Swissy? For example, if a foreign firm wishes to acquire a business in Switzerland, it will have to pay for it using Swiss francs. On the other hand, if a Swiss bank, for example, wishes to purchase a U.S. firm, then it will have to dump its Swissy for the U.S. dollar. The trading tactics. The Swissy pairs, dollar Swissy and euro Swissy, are usually active during the European session only. Both currency pairs tend to be range-bound most of the time. Given this, they are mostly susceptible to sudden spikes and breakouts. As we mentioned earlier, the S&P is very much keen on monitoring the valuation of the Swissy. It is notoriously known to intervene in the forex markets to weaken the Swissy, especially when it reaches some historic key levels. For example, if the dollar Swissy falls back to its yearly low due to an increase in risk appetite, the S&P could just be lurking around the corner to push the pair back higher. You could also trade the Swissy by monitoring the economic fundamentals of its major trading partner, the Eurozone. Any economic or political tension in the Eurozone could lead investors back to the safety of the Swissy. Given this, currency crosses like the euro Swissy could also be used to trade, for example, the dollar Swissy. A rate hike by the ECB, which boosts euro Swissy, could spill over into the dollar Swissy.